How do the wealthiest people on the planet invest? What are their secrets to maintaining and growing their fortunes? What strategies can we learn and apply to our own portfolios? JP Morgan recently did a survey of 190 family offices in the United States and around the world. And these family offices work with ultra high net worth investors with an average net worth of about $1.4 billion. Among other things, these family offices play a pivotal role in managing these ultra high net worth families' investments. There are a number of interesting findings in this study, but the one that really caught my eye is that these wealthiest investors and families allocate about 45% of their total portfolio, so almost half, to alternative investments. Hi, my name is Rasa Tefi. I'm the founder and senior wealth advisor at Yatra Wealth Design. And today I'm going to help explain why I believe the wealthiest investors on the planet allocate about 45% of their portfolios to alternative investments, and how you can apply this same investment strategy to your own portfolio if you have about 500,000 or above to invest. So taking a look again at how these ultra high net worth investors allocate their funds, they have about 45% to alternatives, as I mentioned, and the rest of the funds, about 26%, is in public equities or stocks, and the remaining 21% is in fixed income or cash instruments. So we can see that clearly these alternative investment strategies are a substantial and critical part of the investment portfolios for these ultra high net worth families. The question is why? And the why really breaks down into three main reasons, I would say. So the first one is that there's substantially fewer public equities or stocks available on the market today than there has been in the past. And this is leading to less diversification and more concentration and more risk in the public equity markets. Number two is there's less diversification from bonds, from publicly traded bonds. And really the traditional 60-40 portfolio, 60% stocks, 40% bonds, that was a very commonly utilized strategy for the last 10 to 20 years, has not been working so well recently and is very likely to not be as effective going forward. And the final one, which is that adding, studies have found and results have found that adding alternative investments to the portfolio can both increase diversification as well as reduce risk and increase returns over time compared to a portfolio of just publicly traded investments. So let's take a look at some information and slides to kind of, demonstrate what I'm talking about here. So getting into the first one again, which is that there's really substantially fewer public stocks available to invest in than there has been in the past. And that number has been coming down over the last, 20, 30 years, as you can see on this chart. So we kind of reached a peak in the number of public stocks available to be purchased in the United States in the kind of mid to late 90s here. And then since that point, the number of publicly traded stocks has really, come down pretty dramatically. So we reached a peak of like 8,000 back in the mid 90s. And now we're back closer to maybe 4,300 stocks. So a big decrease over that period. And what's the reason for that? Well, as we can see here, there's really been a lot of take private transactions, meaning companies, private equity companies and, wealthy individuals, a broad variety of reasons. There's a lot of cost involved with having a publicly traded company in the United States these days. So it makes less and less sense for many organizations other than the very largest. And as we can see here, partially because there's fewer companies that are being traded on the public markets, there's actually there's been a big increase in concentration in the public stock markets. And really what that means is, the top 7 companies right now, let's say the Magnificent Seven, is making up a bigger and bigger share of the stock market. And, recently it's been, those 7 companies have basically made up the large majority of the returns in the market. You can see that on this chart here from January of 2023 until, through December of 2023, the top 7 companies were up, substantially over that period. But the rest of the companies in the S&P 500, so the 500 largest companies in the US, they were pretty much flat, just a little bit positive in the last quarter, but for the most part, relatively flat. And what that means now, and you can see this has been a trend that's kind of been increasing since 2012, but the ratio of the top 7 companies compared to the entire stock market is now at the highest level of all times. So when you buy, into the U.S. stock market, you're mostly buying, or substantially portion of what you're buying is just 7 companies. That's a very concentrated portfolio, and it leads to less diversification and more risk. And these vulnerabilities that we just talked about the public stock market have led to more volatility in the stock market over the last couple decades, as you can see by this chart here. And in 2008, 2009, we had a pretty substantial decline. So you can see a pretty substantial decline, almost 50%. And we've had a number of very substantial declines in the last few years. And I do think that volatility is just going to continue going forward because of the fact that there's so much concentration and there's fewer options to choose from. Interestingly, there's also been a lot less diversification offered from international stocks compared to the U.S. stock market. So, for the last number of years, basically U.S. stocks and international stocks have traded very similarly. So when the U.S. stock market was down, international stock markets were down as well. So you haven't been getting a lot of diversification benefits from, investing outside of the U.S. And, part of the reason is that at this point in time, the U.S. stock market is making up, basically 40% of the entire global, stock markets as far as, size and market cap. And that's a pretty substantial percentage. And then as you can see on this chart here, when we compare the US stock market to a number of other stock markets around the world, whether that's Japan or Europe, in the UK, emerging markets, a number of various markets around the globe, these numbers here is showing the US stock market correlation to each market. And you can see that it's quite high. So, the US stock market correlation to the developed markets of Europe is about 90%. So very, very high. Even the US stock market correlation to the emerging markets, like, India, China, places like that, is still about 75%. Comparing to Japan, we're looking at 77%. So these correlations are very high, and you're just not getting a lot of diversification benefits from going international compared to the U.S. stock market. And as we can see on this chart here, unfortunately, in many of the downturns over the last 40, 50 years, when the U.S. stock market has drawn down, instead of getting a diversification benefit, which would really mean when the U.S. stock market goes down, we want something that goes down a lot less, or ideally even goes up. But global stocks have in many cases done the opposite. So when the U.S. stock market has drawn down, global stocks have gone down even more than the U.S. stock market, right? So you're kind of getting, you're not getting any diversification, and you're even taking even more risk. So to summarize, because the public equity markets have continued to decline in size as far as the number of stocks to choose from, and because the correlations of the stock market, both in the U.S. and around the world, have continued to rise. There's less and less diversification options within the public equity markets, both in the U.S. and around the globe. There's higher risk, and so looking at new options makes a lot of sense. So the second reason why I believe these ultra high net worth investors are investing so heavily into alternative investments is that there's less diversification today from the bond market than there has been in the past. And the traditional sort of 60-40 portfolio, 60% stocks, 40% bonds, that has been a sort of go-to strategy for a lot of investors for the last 10, 20 years, and especially for retirees, has just not worked over the last few years due to rising correlations. And we think, it's likely that that risk will continue into the future. And if you take a look at this chart here, from really 1977 until just, let's say through 2021, the 60/40 portfolio really delivered over that long period of time. And what you're seeing here, especially if you look at, like, let's say 2000 to 2002, there was a big downturn in the stock market, 3 years in a row when the stock market was down. But because bonds were offering a excellent diversification benefit and were actually, negatively correlated to the stock market, what that means is the bond market actually went up in those years when the stock market went down, right? And that offered a lot of diversification, and it substantially reduced risk in those years, and substantially reduced the downturn in the portfolio. And we've had other years like 2008. You can see that the stock market was down heavily in 2008, but the bond market was actually up a little bit in that year. And so again, if you had 40% in bonds, you're not only did your 40% not go down in the same year that the stock market went down, but it actually went up a little bit. And so for a long time, investors and especially retirees have been kind of relying on this 60/40 structure to provide them with safety and security and diversification. But this really hit a snag when the Federal Reserve dropped interest rates to close to 0% for a long time, and interest rates went very, very low. And then all of a sudden, they rapidly increased interest rates in 2022. And what that did is it caused a big drop in both the stock market and the bond market in the same year. And you can see here that in 2022, the equity market was down 18%, and the bond market was also down 13%. And so your 60/40 portfolio didn't really hold up, and all in, it was down about 16% for the year. And unlike in the past, when in those years when the stock market went down and the bond market would go up and help kind of reduce the impact, in 2022 it didn't really do that, right? And both parts of your portfolio were down, leading to a big downturn in the 60/40 portfolio. And while in 2023 the 60/40 portfolio did okay, we think that there's going to be a lot more correlation in this between stocks and bonds, and that kind of reliance on the 60/40 portfolio is just going to be less effective going forward. And as you can see here, this is a chart from Apollo, and they're saying that diversification of public markets has been more difficult as correlations have risen. The trailing 3-year correlations between stocks and bonds has been very, very high. You can see it's been over 60%, which is very, very high. So you're instead of having a negatively correlated investment between stocks and bonds, which is kind of what you're looking for, you've had them moving very similarly. So without this major, portion of your portfolio, the 40% in bonds, providing much or any really diversification benefits, we should be looking for other strategies. And that's exactly what the ultra high net worth investors are doing with the alternatives. Okay, so the third and final reason why I believe these ultra high net worth investors are adding about 45% into alternative investments is that adding alternative investments to a portfolio can increase diversification, reduce risk, and increase returns over time. So basically everything you're looking for compared to a public-only portfolio. And I'm going to show you some studies that demonstrate this. So taking a look at this chart here by Apollo, what they're doing is they're looking at and comparing investing in the S&P 500 from January of 2007. So, the 500 largest companies in the US that are publicly traded as an index. So investing in that index from 2008 through September of 2022, and comparing that to something they're calling a public equity replacement portfolio, which is a mix of alternative investments, and it consists of about 50% in private equity, 25% in private debt or private credit, and 25% in real assets, something like infrastructure and other types of real assets, real estate, things like that. And what they found here, looking at the chart is, if we look at the S&P 500 over that period, it had an 8.4% per year rate of return, so pretty good. But it did have a standard deviation, that's a measure of volatility or risk, of about 17.8%. And it had a drawdown of 44% at one point from peak to valley. So a pretty substantial decline there. And it actually had a negative correlation to inflation, meaning that the S&P 500 does worse during higher inflation periods. And then if we compare that to this, public equity replacement portfolio, which again, is a mix of private equity, private debt, and real assets, we can see that the replacement portfolio, the alternative investment portfolio, actually outperformed over that period. So it was up about 9.5% per year. And even better, it had substantially less risk. So it had less than half the risk, with a standard deviation of 7.2%. And the worst drawdown that this portfolio had was about 23% from peak to valley. And so again, less than half the risk, and especially during the worst drawdown, the worst period. And it actually did, during periods that had higher inflation, it actually had a positive, slightly positive benefit to the portfolio over time. So this is kind of a way of not investing in the S&P 500 at all, and kind of replacing that with private or alternative investments. Now we're not suggesting that you do that or go anywhere close to that with your strategy, but it's interesting to look at that and compare, right? Now on this next chart here, what we're seeing is, again, comparing the S&P 500, which is the lighter color, versus the darker color, which is the kind of equity replacement portfolio that I went over. And you can see that during those drawdown periods, the equity replacement portfolio, the mix of alternative investments, drew down a lot less. And it also drew down less frequently, so it had fewer declines than the S&P 500. And over the long run, as you can see by this chart here, the equity replacement portfolio, outperformed, again, with less risk, right? So that's it. If you wanted to take it to an extreme level, which again, just not investing in the S&P 500 at all and replacing it with alternatives. We're not suggesting that, right? And then looking at this chart here, interestingly, what we're showing is that the S&P 500 really does the best during periods of low inflation. And, this is a private markets portfolio and, alternative investment portfolio. And we found, and Apollo has found here that, the private market portfolio, the alternative investment portfolio, actually outperforms during high periods of inflation. And so if you think that we're going to be coming into a period of higher inflation, I personally do, I think Apollo does as well, and many other, large investment management firms over the next decade or so, you're going to want to have a portfolio that does well during periods of high inflation. And unfortunately, the S&P 500, while it does okay, it's definitely not the best strategy for a high inflation period. And looking at this chart here, this is kind of the way I would look at it, more so than trying to replace the S&P 500. I would look at it and say, okay, let's say, for any type of investor that you are, anything from aggressive to conservative, we can add some alternatives to your portfolio, alternative investments, and actually improve the risk return characteristics, right? So if we look at this one here, which is the 40% equity, 60% bonds portfolio, that historically has had a annualized return of about 7.3% per year, and a risk of about 6.8%. And this is going from 1989 through the third quarter of 2023. So a fairly long period of time, and also a period of time when the bond market did really well, right? So I think this is even maybe overstating, how this portfolio is done. And this portfolio, this 40% stocks, 60% bond portfolio, may not do as well, going forward as it has done in the past. But even looking over this period of time, um, if we had added about 30% of alternative investments to that same approach, and instead we had a portfolio with 30% stocks, 40% bonds, so kind of the same proportion there, but we also had about 30% in alternatives, right? Then that portfolio actually, really substantially outperformed. So we can see that the return over that same period was about 8.4% per year. And even better, it had even a little bit less risk, right? So substantially higher returns with a little bit less risk. And then, going back to the 60/40 portfolio, so that's someone who's a little bit more aggressive and utilizing the classic 60/40 approach, right? 60% stocks, 40% bonds over that period. That same, period from 1989 through third quarter of 2023, that 60/40 portfolio would have achieved a return of about 8.3% per year with volatility of 9.6%. But if they had again added 30% to alternatives and kept a similar proportion of stocks to bonds, so 40% stocks, 30% bonds, and 30% alternatives in that case, then that portfolio actually again outperformed, right? So instead of an 8.3% return of the 60/40 portfolio, we're at 8.9%, so pretty good amount of outperformance. And even better, we had a substantially lower risk in that portfolio. So instead of 9.6% volatility, we had 7.9% volatility. And so, you can really see here that regardless of where you want to fall on the risk return spectrum, these adding alternatives to your portfolio can really substantially outperform and substantially improve your long-term outcomes. And I think that this outperformance will be even greater in the future than it was in the past. So we've gone over a lot of really interesting information, and at this point you may be thinking, okay, Ross, I get it. These family offices and ultra high net worth investors are onto something, but I'm not an ultra high net worth investor with a family office. How can I apply this to my own investment strategy? Fortunately, these days, if you have over 500,000 to invest, you can in fact invest in alternative investments. In fact, our clients often have a variety of these alternative investment asset classes in their portfolios. Some of the strategies we utilize enable you to invest right alongside these ultra high net worth investors with the same or very similar strategies and investments. And we found these strategies to be very valuable in providing more diversification to portfolios, reducing risk, and increasing long-term returns. However, we've also found that most retail investors don't utilize these strategies effectively. So why is that? Unfortunately, many advisors are really not set up to be able to offer these strategies to their clients. They may be captive to a particular bank or a large organization, and this typically limits them to only offer a very select group of alternative investments. Often that organization's own in-house products, which may not be very good. In fact, there's really quite a few poorly set up and poorly performing alternative investments out there, and those often target retail investors. So it's important to find an advisor with the expertise, independence, and who is a fiduciary, a legal fiduciary, so no financial conflicts of interest, to really help you in this area. And despite the challenges, as we've discussed, adding the right alternative investments to your portfolio can add tremendous value, similar to these ultra high net worth investors. So if you'd like to learn more about how to invest similarly to these ultra high net worth investors, please reach out to us or leave a comment below.